Good morning. I'm Nicola Barrett, Chief Corporate Learning Officer at Emory Executive Education at Goizueta Business School. Thank you for joining us today in the first of our series of Business Over Breakfast. Our school is named after Roberto C. Goizueta, the former chairman and CEO of Coca-Cola, whose approach to business and leadership guides and inspires us. He was driven by curiosity, intellectual courage, and integrity. All things that are so pertinent for our current challenging times and for shaping a positive future. Our goal with this webinar series is to do just that, to help shape the future by helping us understand what's happening in the economy, how this influences and impacts us individually, our families, businesses, and communities. To help us understand what's behind the headlines and how this informs our financial decisions, I'm pleased to introduce Tom Smith, Goizueta Business School professor in the practice of finance, who is an expert in the areas of labor economics, pricing, sports economics and financing, and the economics of entertainment industry and healthcare. What aren't you a specialist in, Tom?
I'm not sure.
So teachers in our Finance for Non-Financial Managers executive education program that is coming up next week. According to one of our past participants, he said, Tom is a great instructor. He is engaging and made the class feel more like a finance conversation than a lecture. It was refreshing to learn from someone who is so passionate about the topic. This was a wonderful class. It has taught me so much more than I would have ever imagined. Needless to say, there is no one more qualified to address the topic of the economy and me than Tom. Just a few words about how this session and the series will work. Tom is going to kick off the webinar with some observations about what is happening in the news, what it means for the economy and for individuals, followed by about 30 minutes of Q&A. Please write your questions in the Q&A section at the bottom of the screen, and our team will do their best to get as many of these questions to Tom as we can today. And if there are any left over, we'll post additional questions and answers on the Emory Executive Education LinkedIn page. So please look for that and follow that. At the end of today's session, there will be a very short 5-question survey that we would appreciate you filling in. So please enjoy the morning with Tom, and I look forward to continuing the conversation each Thursday morning in April. Thank you.
All right, thank you, Nicola. I appreciate that. Can you just confirm that my sound is pretty good here? Excellent. All right, thank you. All right, I'm Tom Smith. I'm a PhD economist and finance professor at Emory's Goizueta Business School, and I appreciate the introduction from Dean Nicola. I've been teaching at Goizueta for 12 years. I'm from Chicago, native Chicagoan, and I teach in every program that Goizueta offers, from the pre-undergrads to the executive MBAs, teaching executive MBA programs, and teach healthcare workers, teach postdocs, and so I have a nice view of what's going on at Emory. But I also talk in the media quite a bit about national events, and so I'd like to talk to you guys today about this national event here. We all know what's going on, but we better get a good sense about how bad things are, how the stimulus package is likely to work, where we're likely to be headed, okay? I've been talking the last week or so about comparing this event to what we saw in New Orleans after Hurricane Katrina, okay? The reason I've been comparing it to Katrina the last couple of weeks is because the amount of disruption that we're seeing in the economy mirrors the kind of disruption that we saw in New Orleans after the hurricane in 2005. This is a graph. These data were drawn right from Fred St. Louis website. This is a graph of the unemployment rate in New Orleans right after Hurricane Katrina. We can see that you have this huge spike in unemployment. It goes from about 5% all the way up to 16%, okay? And so this is within a month. Fortunately or unfortunately, Hurricane Katrina happened right at the end of the month, and so then they have data from August, and then they have data from September, October, November, what have you. Well, the unemployment rate spiked up. You have hundreds of thousands of people who were displaced, didn't have a home. It tens of thousands of people who left New Orleans and went to Houston, went to some other places, but a lot of people went to Houston. And so there was this huge disruption in that community. I like to think about our current disruption as being a disruption of this sort because it doesn't follow the same kind of patterns that we typically see in an economic shock. Okay, an economic shock is something that we don't exactly know it's going to happen, and then it hits us, slaps us up against the face, and we have a hard time either reacting to it or coming up with policies that can match what the shock is throwing at us, right? And so our last economic recession was the housing crisis and the meltdown. That was driven by subprime mortgages and then the failure for people to pay back those mortgages. Prior to that, we had a recession in 2001. That was part of the dot-com bubble. There was an Enron, WorldCom crisis where they were essentially lying to investors about what they were doing and what their P&L looked like. But we also had these terrorist strikes in Pennsylvania, in New York, Pentagon. And so what happened is people had, they had a demand side shock. They became a very, let's say, complacent in terms of their spending. They didn't want to spend anything. And you saw this huge decrease in what we call aggregate demand. We saw the same kind of thing happening as demand side shock in 2008. And I believe that that's what we're going to be experiencing is a demand side shock. It's not like businesses can't afford to run, or it's not like there's underlying reason that's throwing businesses out of business. It's they have to be shut down because of the government. There is a reason to extract businesses from the economy so that they're not interacting with other people or people aren't interacting with them and spreading the virus. So they're being shut down, which means people are becoming unemployed very, very, very quickly in this huge spike. And so this is what I'm showing here. If you look at initial unemployment claims, that's what this is right here. So this is the initial unemployment claims in New Orleans, Louisiana, after Hurricane Katrina. It spikes up to about 75,000 people. This is the initial unemployment claims, about 75,000 people from 2 weeks ago. This week, it's even worse. So this is the unemployment claims here, the initial unemployment claims for the U.S. And for March 21st, it was about 3.283 million. You've been hearing this term, 3.3 million people have applied or had initial unemployment claims. So now they've got data for last Friday. It was double. So it went from 3.3 million initial unemployment claims to now 6.6 million people in terms of initial unemployment claims. I saw a report that said 1 in 5 people in New York are identifying themselves as either unemployed or furloughed. Okay, that's 20% of the people who were surveyed. My perception of this event is that you take this New Orleans situation here, right? After we saw Hurricane Katrina, we're going to replicate that, and then we're going to replicate that for every major city across the entire United States. And so this 15% initial unemployment, this spike, that's what's going to be happening in every major city, although some cities like New York, probably Los Angeles, maybe Chicago, will be reporting unemployment rates maybe twice that initially. So instead of 15%, you might already be up to 30% or 35% unemployment. Okay. The way that the government has combated this, right, and the way that the government typically combats an economic recession is to reveal policies. So we've got the Fed, which reveals monetary policies, okay, dropping the federal funds rate target. The Fed did this very, very quickly. They made 2 initial moves. They dropped about 50 basis points, and then they dropped it all the way down to 0 in very, very quick succession. So now we've got federal funds rates at 0, okay? That's the expansionary monetary policy trying to make liquidity happen. The second part of this is we have this fiscal stimulus package called the CARES Act, which has a number of different elements to it. Okay, and the elements in the CARES package have to do with emergency loans, all right? So emergency $10,000 grants for small businesses, this thing called the Payroll Protection Plan, which is supposed to give people about 2.5 times what their average payroll is so that they can use that money to keep their workers on their payroll. A lot of companies have been furloughing workers, laying them off. This payroll protection plan is aimed at trying to mitigate that by getting people to not fire their workers. Here's some money, keep your workers on. And if you use that money to keep your workers on, it looks like those funds are going to be forgiven. Okay. There's also a part of the stimulus package which includes checks for individuals. So $1,200 checks for an individual, twice that for families, additional checks of about $500 for each kid. Those amounts phase out after, depending on how you filed, after levels of your income. So the top level for a family is $198,000. And so if you're making more than $199,000, you're not going to get a check. Just this morning, the Treasury came out and said that people on fixed income, Social Security beneficiaries are going to receive the check even if they didn't file taxes last year. So if you didn't meet the minimum threshold to file income taxes last year, the way that the CARES package was originally established was that you weren't going to get a rebate check, this $1,200, unless you filed taxes, because it's based on the amount of money that you reported that you earned last year. But now Social Security recipients are going to receive this $1,200 check without having to file taxes. So that's a new addition just this morning. I have a lot to say. I've been talking for about 12 minutes, and I'm curious about questions or if people have some initial responses or initial thoughts about what I've just said.
Hi, Tom. This is Keisha. There are questions in, and there was one comment to see if you could zoom in on the graphs that you're showing so that the figures could be shown. And the first question that has come in is asking if you would compare what's currently going on to the September 11th aftermath, in particular, for what could it be in the mid to long-term effects?
Well, so here's what's so interesting about 2011 2001 as an economic recession was actually a very, very small recession. It didn't last that long. So officially that recession went from about March all the way through November of the same year. So about a 7-month-long recession officially. And in case you're not aware, there's the NBER, the National Bureau of Economic Research. They have a committee called the Business Cycle Dating Committee. The Business Cycle Dating Committee is let's say, the umpires of the economy, if you will. They determine when a recession has occurred and when it has stopped. So when the peak of the recovery has happened and when the trough of the economic recession has happened. So they're calling, if you will, the balls and strikes on the economy. Typically, the NBER waits quite a while after the economy already starts to downturn in order to call a recession, because it has huge implications for policymakers, for people. What you don't want to do is scare people into the idea of a recession and then have them withhold their expenditures, right? Consumer spending makes up about 70% of our GDP. And so this NBER, they didn't even call the recession until November of 2001. And by then, officially, it was already over. About a year later, they said, yeah, the recession, when we were making that call, the recession was already over. 2001 was a pretty mild recession in terms of the hit to GDP, okay, a couple percent. Their unemployment went up to about 7%, and then it tailed off very gradually. At the time, we were calling it a jobless recovery. It was not this, let's say, V shape that we would hope for. So this V shape would be if the economy goes into a trough and then it recovers very quickly. And so you see this V for unemployment, right? The unemployment would go straight up and then straight back down, right? Or the GDP would go down and then straight back up. We saw some recessions like that in '82 where the economy covered really quickly, but 2001 was a very long economic recovery. So there's sort of two ideas, two thoughts here. One of them is that everybody is being quarantined, everybody is being very diligent with respect to how they're spending money now. They have a job, they're trying to save. If they don't have a job, they don't have any money. So it's nobody's spending very much right now. Okay, they have nothing to spend it on. But it's potentially possible that when you hit the fourth quarter, this could explode into a bunch of consumption because of latent demand. And so latent demand would be nobody's done anything and all of a sudden everybody wants to go to the movies like every day, or nobody's been to Six Flags and so everybody goes to Six Flags, or nobody's been to Disney, everybody jumps to Disney, or everybody goes on vacation or something like that. That would be an explosion that would take us from an economic recession to a recovery very quickly. I am a little bit more pessimistic because what we saw in 2008 was that companies they fired a bunch of workers. Unemployment went to about 10% in the 2008-2009 economic recession. We saw that firms were very reluctant to rehire because they were certain that the economy was going to go into a double dip recession. And so for years later, companies were still saying, I'm not going to hire, I'm not going to rehire, because I think that if we go into another economic recession, I need to be prepared. My fear is that companies will reopen, but they might not hire back their entire staff because they don't want to get caught in a very vicious cycle of hiring and firing and hiring and firing. As you know, if you're a business owner, hiring people and firing people is very costly. It's very expensive in terms of time and your resources. And so some firms might say, well, I'm going to try to get along on a skeleton crew because I don't want to have to go through the process of bringing people on and then firing them and doing that again and again and again and again and again. So they might be very hesitant before they know if we can really keep this virus at bay. So if we get a vaccine or we're able to find its underlying causes or find some kind of prophylaxis, something that prevents us from getting this COVID, they might be very, very hesitant. And as a result, you get this very slow recovery. So I guess it could look an awful lot like the 2001 recession with respect to a jobless recovery. I'm hoping not, but I think it very well might. Any other questions?
Tom, could you give us your thoughts on the 4 phases of the care package and how many more phases you feel might be needed based on the data from Katrina?
So the CARES package, so here's the news that's coming out this morning, is that, and this was actually last night, is that the House of Representatives is already thinking about putting together another stimulus package on top of this package. The CARES package has some individual checks, but those are not likely to go out for maybe 4 more weeks. Okay, so that's very challenging. So you've got this CARES package in terms of your individual checks. Those are not going to go out for a couple weeks. You've got these emergency loans, so SBA emergency relief loans. You can go to the SBA website right now, the Treasury website. We'll make sure that I get those links to you guys, so Emory will post those links. You can apply for a $10,000 grant that looks like it's going to be 100% forgiven. Looks like the wording is a little bit tricky, but it looks like those grants are going to be 100% forgiven. And allegedly, those should be in your account within 3 days of the application being processed and accepted, however long that is. Okay, but they should be in the bank in 3 days. But now there's the SBA loans with respect to the payroll protection plan, which offers up to $100 million or 2.5 times your monthly payroll. If you use that to cover your workers, all right, for the next 8 weeks, then a large portion of that money will be forgiven. Right now, the Treasury has assumed they're just going to forgive 25% of those loans. So we're getting a payroll check. If you've filed taxes, you're going to get this emergency relief is available right now, and the payroll protection plan is available right now. I mean, prior to the CARES, there was already some different packages that were put in place with respect to family and medical leave, changing the laws on that, extending unemployment insurance, and setting minimums for unemployment insurance. So people should be getting about $600 per week if they're filing for unemployment. Here in Georgia, you have to be aware, and my wife, who's an HR expert, has been helping people with this. If you're a company, you have to be filing those unemployment claims yourself. Typically, the person who's filing unemployment, so if I was unemployed, as the employee, typically I would be making that paperwork. But now the way the law is set up is that employers are the one that have to actually be filing that paperwork. I don't know if I got to all the elements of that question. I think that there has to be another round of fiscal stimulus, and I think it has to be aimed at healthcare workers, and states, allowing states to have resources that they can use that makes the best sense to them. I know a lot of states, you probably heard Cuomo talking just about every day on TV and on the radio about what's going on in his state. He is the best person to understand what makes sense in his state, right? The governor of our state is probably in a good position to understand what's going on in Georgia, and same thing in California and Illinois. And different governors are rolling out different sets of plans for their states based on what they see are being, let's say, good policies. So I think there's to be another round of stimulus that is designed to give states a bunch of money that they can use very quickly. So I'm guessing another maybe $2 or $3 trillion, maybe four, maybe it has to be double that, $4 to $6 trillion just for states so that they can implement emergency plans for their hospitals, their physicians. One of my MBA students said last night that his wife, who's a nurse, and a couple of her colleagues are actually going to New York for about $10,000 a week to relieve some of their healthcare workers because they are just exhausted. And so they've been hired to fly to New York and work in some of their facilities, ER rooms, for the next 2 weeks. And they're being paid $10,000 a week to do that. They're putting their lives on the line. But it's to be admired that people are stepping up and doing what needs to be done. But I think another round of stimulus, maybe even 2 rounds of stimulus, might be in the books.
Tom, there's a question. What are the immediate and long-term effects of such a grandiose government debt?
Yeah, so, well, there's a couple things that are going on with respect to debt. I mean, we typically think about debt, and a lot of people like to say, well, think about the U.S. like my house or my household. My household has to manage our payments. So we've got my revenue versus my expenses, and I can't carry so much debt. The United States is a huge house that doesn't have the same kind of restrictions that you do. That is, you have restrictions on how long you're going to work. The United States doesn't really have this restriction. The United States can continue to work for as long as possible. People get very, very anxious about going into debt. So having debt, let's say being 90% or 98% of your GDP. I mean, as a result of these kind of stimulus packages, we might have our debt being 100%, 120%, 130% of our GDP. Typically, in countries like Greece, this essentially causes Greece to fall apart. But we're not Greece. We're very, very diligent about paying our debt payments. So the Treasury is going to have to issue a whole bunch of new Treasury stock, Treasury bonds, Treasury bills. Okay, we're going to go into this huge amount of debt. Typically, and I've been talking to this with various groups in the past. When I say in the past, I'm talking about President Reagan, President George H.W. Bush, not our most recent presidents, but some previous presidents, even Clinton did this, is that after we have a stimulus package, after we go into a recession and we take on a lot of debt as a result of these stimulus packages, then as we come into a recovery, we actually increase the tax burden gradually to try to pay back that debt. And that was, Reagan did this pretty successfully. George H.W. Bush did this, where he actually imposed some new taxes, even though he said no new taxes. It's not a politically popular way to go about your policies. It is very fiscally responsible. And so if you go into debt, you're going to have to pay back their debt. Some countries like Chile operate in a very fiscally responsible way. So when, let's say, the price of copper, which is Chile's largest export, goes way up, Chile actually reduces some of their government expenses and puts some of this money into reserves, so that when prices of copper go down and Chile would be going into an economic recession, they actually increase what their government expenditures are, increase, let's say, unemployment insurance or pensions or whatever else, so that when things are great, they're not that great. But when things are bad, they never get bad. So that it's a very kind of mild roller coaster, like a kiddie roller coaster, okay? But the way that we've been tackling this is that we've been giving lots of fiscal stimulus, and then we've been having tax reductions during our recovery, okay? It's tax reductions don't make any fiscal sense during a recovery. The way that you can pay for your fiscal stimulus, like these packages, is by increasing your taxes when you are back into a recovery. Again, it's not a very politically sound plan. If you want to get reelected, having your taxes go up isn't the way to do it. But it makes sense for a country to start thinking about the long-term aspects. I wouldn't be too concerned about going into debt. So the U.S. is already in debt. We'll issue some more stocks. I'm concerned about the immediate taking care of people. And the government has the most power to take care of people, so they should use all of their power to do that. Individuals, we do not have the opportunity to leverage as much as the government can. And so the government going into debt, not a big deal. But when we come out of this, we do have to be more fiscally responsible. I believe we have to increase taxes, and people have to pay for it. That's clearly an opinion, but it's pretty sound economic policy.
Tom, what can we expect for the stock market and real estate industry?
Yeah, so let me start with real estate. Real estate's in real trouble. All right, so April 1st, yesterday, there's, according to a resource I just saw, $80 billion in rents are due in the next 10 days. $80 billion in rents, okay? $90 billion in interest payments for consumer debt and asset-backed securities. So that you've got, $170 billion in payments that are supposed to be coming in the next 10 days. It makes up a huge share of sort of economic churn, if you will. So I think real estate is in trouble if you own a bunch of rental properties. You're going to have to get some kind of forbearance from your bank, clearly, because your renters aren't going to be making their payments these next 10 days. And when they stop making their payments, you're not going to be able to make your loan payments to the bank. So the bank's going to be holding the bag, if you will. And so if you're owning these properties, you're going to be in trouble. There's, large banks and other kind of, let's say, equity companies that hold commercial grade CMBSs. These are commercial mortgage-backed securities. So a large property like a strip mall or like a mall, some kind of a property like maybe an office building or what have you. And the office building has value because there's renters inside the office building that are creating a cash flow. Well, all of these companies are going out of business, or they're firing other workers, or they don't have any revenue. So the mortgage payments, rent payments on those CMBs, they're not going to be made. So mortgage payments are not going to be made. Loan payments are not going to be made. Real estate is in real trouble because the underlying value of the real estate isn't being, let's say, compromised. So the building still has value. Those companies could make payments if they were allowed to be open, but they're not, right? Individuals could make payments on their mortgages, but they've all been laid off of work. So it's not like the underlying value of a house is decreasing, or the underlying value of, let's say, rental property is decreasing. It's just you have a liquidity crisis. Nobody has money to make those payments. And as a result of not having money to make those payments, now they're going to go into sort of massive debt themselves. And so if you're owning real estate, you're in trouble. Demands for mortgages are falling. Okay, people are moving out. They're vacating their rental spaces. So we're going to see this huge hit to the real estate industry side. All right, what we need some kind of a nationalized policy on loan forgiveness, loan forbearance. When I talked to my bank last week, they were going to take the mortgage payments and they were going to delay them. But then in 90 days, I would have to make, let's say, the full payment, full restitution for the missed payments in 90 days. If they have this policy with everybody, you're in trouble, because if people are out of work now, it's not as if they're going to get triple their income when they come back. So any kind of forbearance has to be tacked on to the end of the loan terms. It is not clear that every bank is doing this. I know, because I talked to somebody last night who reached out for help, and their bank is tacking those 3 payments on at the end of their loan. If they're not doing this, the banks are not going to get their money in 3 months. If they are doing this, it basically changes the structure of those loans and changes what's on the balance sheet for banks. So you need to have some kind of nationalized policy that says we are going to have nationalized debt forgiveness, a timeout, if you will. Put everybody into a 90-day timeout. But in order to do that, what you need to do is have the federal government change the regulations for banks, because right now banks need capital requirements based on the kind of assets that they hold. And if all of a sudden these mortgages that nobody's making payments on become identified as distressed or risky assets, then the amount of capital required for the bank escalates, and banks don't have those capital capabilities. So the government is going to have to step in and say, 90-day timeout for everybody. Let's tack them on at the end of your whatever your loan term is, and no penalties, and say to banks, don't worry about it. You don't have to meet the capital requirements now that these assets are more risky. So real estate is in trouble. We need some fixes there. With respect to the stock market, I wouldn't try to overguess what's happening. In 2 weeks, we lost all of the value that we had gained for 3 years, right? That's insane. And so we're down for the first quarter. Things are not looking good. People are trying to guess which companies are going to be hot commodities, like Zoom. Depending on which Zoom you might buy the right Zoom, you might buy the wrong Zoom. But I would not try to overguess what's going to happen with the stock market. I've always said the stock market is not the economy. It is a measure of economic activity, but it's not the same thing. They're not the same thing. So our stock market is down. A stock market might jump up 1,000 points or down 1,000 points any day, depending on how jittery investors get. But I would be hesitant to try to overguess what's going to happen next, because people might just decide to sell everything. My one consistent policy since I was 18 has been buy what you buy. You know, if you got Coca-Cola in your refrigerator, buy Coca-Cola. You're wearing Nike shoes, buy Nike. You drive a Toyota, buy Toyota. You drive a Ford, buy a Ford. I mean, if you're willing to buy the company, you should buy the company. That's just, but that's, I'm not parsing it into, you know, looking at financial indicators and financial health of a company and what their long run trends are. I'm talking about just very simple sort of techniques for getting your investing strategy together. But I think the market is in trouble. Clearly we saw it in trouble. I think real estate is in worse trouble than that. And this is not a whole lot of good news, people, and I'm sorry that I have to be talking about such bad news, but we can anticipate that it's going to be a long, long ride for us to get through this economically.
Tom, question. How is the US curve comparing to the global unemployment curve? And then there's also another question. I'm going to try to combine these. We're getting lots of them. How is the stimulus package going to affect the middle class and their taxes?
Yeah, so my understanding is that, let me answer the last question first. The stimulus package with respect to taxes. So there've been a lot of parts of the stimulus that aren't going to impact your taxes in any way. So you're not going to get taxed on this $1,200. That's my understanding. You're not going to get taxed on this $2,400. This is payment that's coming from the government. They're not going to tax you on this. There've been some other elements too. So you can now extract part of your savings. So if you have like IRA savings, a SEP, something of this nature, you can extract some of this without the penalties. So typically you would be penalized for going into your IRA and what have you. But now you can go in there and extract some of that for casual learning, or excuse me, casual living. That is going to end up on your taxes. If you withdraw some of your funds and use them for your income, you'll be taxed as if it's regular income. Okay. The rest of the stimulus, though, it looks like they haven't added any kind of, let's say, a tax deduction or a tax reduction, a tax break, if you will. Everybody's getting a stimulus, or a lot of people are getting a stimulus, so that subsidy should act as a negative tax, but I haven't read anything that is decreasing, let's say, our marginal tax brackets or rearranging them or forgiving them. I know that the tax deadline has been pushed out to July, so that's going to change the nature of when people pay. And so I would anticipate that if Congress does another round of stimulus that they might approach it from a tax perspective. I know this was what President Trump was initially talking about, having a payroll tax exemption or a deduction to try to get people some of their money back into their paycheck, but it was a very, very small amount and almost got no traction. There might be other things that they could do to actually give people a lower tax burden. I would anticipate that that's the next round of stimulus will include some kind of a deduction or a rearranging of the tax brackets. The first question that you asked was, how does our unemployment curve look relative to other countries? I think, is that correct?
That is correct.
Yeah, so our unemployment numbers are going to come out for the first Friday in the month for the last month, and they're going to be very odd because half of the month people have worked and then the other half of the month people didn't work. So I would anticipate that those numbers are going to be very skewed. Next month, we'll get numbers on all of April, and those are going to give us a much better sense. I fully anticipate the unemployment is going to hit 15 to 25%. It probably is right now about 20%, but it very well could hit something like 50% in the long run. If we are talking about, let's say, 4 or 5 weeks before we're hitting our peak of the number of new patients or the peak number of deaths, and then as that declines, another maybe 6 to 8 weeks. So we're talking about maybe a full quarter of us being sort of quarantined out of work, out of business, working at home, what have you. And so if that goes all the way, all of April, all of May, all of June, then we're going to see something like maybe 50%, 60% unemployment. It is, different countries are engaging in this in different ways that are trying to stem the unemployment. So Denmark is just making a nationalized policy. They're giving everybody 75% of what their wages would be. So just, we don't really care, you're employed, unemployed, whatever else. We're just going to write a blank check for everybody. So everybody stay at home. Here's 75% of your wages. You can live on that. We're going to put some moratoriums on foreclosures, moratoriums on people getting kicked out. And so it's a very, very nationalized policy. But then what will happen is when it's over, Denmark will probably have fewer cases and they'll come off the curve much quicker, and then their economy can get back to working. So just a huge amount of capital, a huge amount of expense by the government, and then the economy gets back. If we have this lack of a nationalized policy, then we could see a rolling of we could see a rolling impact in terms of which states, which cities are impacted next. And so this could last a quarter. It could last all the way through the summer and into the fall. And if that were to happen, we would be in significantly worse shape than other countries that have a very strict policy on going out, mingling, what have you. The fact that we still have 11 governors who haven't even had a stay at home or shelter in place order means that for a country, this is going to drag out longer. So now in Fulton County, we have, a shelter in place order. Well, if they don't have the same thing in Tennessee, if they don't have the same thing in Alabama, all it takes is one person to come in back to our community who's infected and restart this thing all over again. So we might do lots of really good work here in Georgia, and one bad actor could undo it in a heartbeat. And so it is possible that our curve is going to be much worse and last much longer than other countries that have very, very strict containment policies.
Tom, as it relates to Georgia, some say that our economy is well positioned to rebound faster than other states once this shutdown concludes. What are your thoughts on that?
Yeah, so Georgia, we really took it on the chin during the 2008 recession. We have lots of North Georgia is very involved. It still has lots of industry connections to the housing market. So up in Tunnel Hill, lots of carpeting and flooring. We've got companies up there that make lots of materials that go on roofs, roofing shingles, the underlayment, housing wraps. Our woods up there provide lots of resources for housing. So we came out of the last recession very poorly positioned. So we really took it on the chin. And Georgia's unemployment was 1 or 2 or 3 points higher than the national average all the way until it's 2012, 2013, 2014. I mean, we were still lagging really far behind. Currently, we've got a very balanced economy, and so we've got healthcare technology. The part that I'm a little bit anxious about is that we have, at least in Atlanta, we have put a lot of our eggs into the entertainment and movie business. And so we've got a lot of entertainment and movie business going on, and those shoots are all done. People aren't going to the movies. They're not making movies. So that part of our economy is going to fall apart pretty quickly. It's not clear how fast we can rejuvenate that after this is done, and think that people still want to be entertained, but I think it's going to take a little time before all of a sudden we've got movie shoots everywhere. The kind of companies that are still here seem to be doing pretty well. So we've got our Home Depots, you've got your New Rubbermaids, you've got your Coca-Colas. Those companies are still doing some robust business, but companies like Delta, right, they are not. They are taking it on the chin as well. I mean, which would make sense because flights are being canceled. Nobody wants to fly. So we've got a really good industry mix. Some of our industries are going to be very susceptible to the type of economic recession that we're having now, which is, this shelter in place, don't go out, don't spend money, close the businesses because we have to recession. So as a result, people are becoming unemployed, but they certainly don't want to fly, and they might like to go buy things. So I would say that parts of our economy are well positioned. Clearly, Delta, as one of our good community members, is not. I mean, they're going to be in bad shape when this is done. Our Home Depots might be okay. Our new Rubbermaids might be okay. But other industries, they're going to suffer quite a bit. So it's hard to tell. Looking at, I know we're pretty. We're not as poorly positioned as we were coming out of the housing recession, but some of our companies are definitely going to take it on the chin, and I think Delta is one of them.
Tom, could you speak more specifically to the impact and options for graduate students, full-time or otherwise?
Oh, so graduating students, or I mean, so like,
The question is graduate students, but the student population,
yeah.
I think.
So the student population they're going to be in trouble. We have seen from our undergrads that a lot of our undergrads are having their jobs rescinded. So they were going to go work for Deloitte in New York, or they were going to go work for Accenture or what have you. Their jobs might be going away, okay? That's not good news for them. For graduate students, again, MBA students, they might not have a job. All right, they might have been positioning themselves and took a year or two off of school, and then they're planning on going back in at a much higher place on this ladder. I think that they're in trouble because there's no jobs. What I would recommend for students who are thinking about graduating, and this happens every economic recession, is become more educated. I know it sounds a little bit crazy, but it actually makes pretty good sense. So if you are, let's say, an undergrad, you might want to think about continuing your education and get a specialized degree. If you weren't thinking about going to law school, you might want to think about that. Of course, you're taking on some more debt, but it might be a better option during this year. Instead of taking a gap year where you're backpacking over Europe, which you can't do, your gap year is now getting right back into school and becoming more educated. So if we can come out of this recession where we've got a group of our workforce is actually more trained than they would have been otherwise, then there's opportunity for us to grow at a much quicker pace. And so I am talking to students about, is there a graduate program that you might want to jump into? Have you thought about going back and getting your MBA? Can you get your MBA right away? Or you thought about getting other types of specialized training? Is there some options for you? Mostly because there's no jobs. And unlike the last recession, where, let's say, people got fired in the financial services industry or the banking industry or other industries that were directly linked to those, and they said, fine, I got fired from my regular job, but I'm going to go work as a bartender or go out and try to do, side work. I'll do some wait tables or what have you. Those secondary jobs aren't around anymore. So you can't say, I'm going to go work as a bartender. The bars are closed. You can't say, oh, I'm going to go, do a waitressing job or something like this. That's closed. Like go work at a car wash. That job, they're not hiring. So I am encouraging people to continuing building their human capital. That will help our economy in the long run. Smarter people helps every economy. No economy has ever suffered from smart people who are better trained, people who are more productive. So you say, I'm about to graduate and I don't have a job. Okay, think about continuing your education. It's going to help you and it's going to help the economy. You're just going to have to put off work for a couple of years, but there's no work this year. So go get some more training.
Tom, can you speak to policies being put in place that may protect the economic future in case we're hit again in the fall with a spike of the virus?
Yes, so this is, every day a new policy is being rolled out. Like I said this morning, the Treasury said that people who are living on fixed income, people who are receiving Social Security benefits, they're going to be receiving checks. All of the current policies have all been stopgap measures. Like, okay, let's put a stitch on this. Let's put a stitch on this. Let's put a stitch on this, right? So the economy is getting into bicycle accidents and we're putting Band-Aids on everything that has been injured. What we haven't done is put a helmet on the rider or get traffic out of the way and allow the bike rider to continue down a path that's going to be less dangerous. I would fully anticipate that the next round of stimulus is going to address those things. How do we make things, let's say, more secure? I would like to see a very robust stimulus package, similar to, let's say, WPA, where you're putting everybody to work, right? We've been talking about building infrastructure and improving infrastructure for almost 4 years, right? So during our last presidential election, both candidates were talking about building infrastructure, that we had crumbling infrastructure, that our railroads and bridges and airports could all use some investment. Well, now's the time to engage in that kind of policy, right? When we come out of this, have a nationalized policy to, fine, let's redo all of our infrastructure. I mean, people whose industries have gone away, and I fully anticipate that some industries are never going to come back, or they're not going to come back in the way that we saw them before. So it might be that everybody wants to go out and watch the movies. It's possible that movie theaters just never gain traction and they go out of business. It's possible that all types of little boutique stores that people like to go to end up never being able to come back. So there could be huge portions of our economy, our current economy, that people say, I don't need that, right? Orange Theory, who knows? Maybe I don't need that, right? I've been driving my Peloton for the last 3 months. So there's going to be a need for us to replace those industries that go away with something else. And a nationalized policy to rebuild our infrastructure might be exactly what we need to grow our economy. I wouldn't be surprised if we hear something in the next month about these type of very grandiose policies. I think that's what we have to do.
Tom, what are your thoughts on modern monetary theory and the ability for the central bank to create more money instead of adding to our debt?
So the central bank doesn't add to our debt. The central bank engages in monetary policy. So what they're doing is they're buying and selling treasury securities from other banks to create liquidity in the market, okay? And so typically people are anxious about monetary policy because when you put more money into the economy, you can actually create inflation. All right. And so if you've ever watched a Survivor episode where they have these auctions and they give everybody $500, they sell cheeseburgers for like $300, right? If you sprinkle huge amounts of money on everybody, you get these massive inflationary tendencies. We didn't see this during our last recession. We never saw the inflation because banks were very, very hesitant to loan. So here's what the Fed is doing and what they have to continue to do, okay? There is a huge liquidity crunch going on right now. So banks have these mortgages on their balance sheets. They are relying on these mortgage payments to either make additional asset purchases or to pay off their own debts, to pay off other kinds of obligations. And the way that the mortgages work is that they get classified as an asset that's either very stressful or not stressful. And then banks have to pass certain types of stress tests in order to be compliant. Well, if all of these mortgages start failing, then banks are going to have to liquidate, let's say, their best assets to try to get the capital to cover now these mortgages on their balance sheets, which are now, let's say, being classified as distressed assets. Well, the Fed can step in, and the Fed is stepping in and engaging in all types of creative monetary movements. So making repo swaps. So they're going in and they're actually buying assets overnight, giving banks liquidity. So if the Fed steps in and creates that market for the banks, then banks have the funds that they need to operate. Remember that April 1st, yesterday, through April 10th, right, $80 billion in rents are expected to transact. Let's suppose that half of that doesn't occur. Banks will be seriously distressed, right? And so if the Fed can come in and buy an asset from a bank, it's essentially creating currency in the economy, but the bank can use that to offset this now distressed asset. Otherwise, we're going to have bank failures, but not because of the underlying value of the assets, but literally because they don't have the capital to meet the capital requirements that are established by regulators. So the Fed is doing everything it can to pump liquidity into the market. What the Fed also needs to do is to explain this to regulators and say, look, we need a timeout here. We need to give banks some kind of a free pass, if you will, so that they don't have to worry about hitting these particular ratios, these stress tests and what have you. Otherwise, banks are going to continue to sell off their liquid assets, and they're going to be in bad trouble when this thing rebounds. And so the Fed is doing everything they can to create liquidity. They're not adding to the national debt by doing so. All they're doing is that they're propping up the system that is about to collapse. And they need to continue doing this, and they need help, though. They need regulators to come in and say, we're not going to hold banks to the same capital requirements that we currently hold them to. This is a really, really important point. You're not hearing a whole lot about this, but in the next 15 days, something has to happen or our banking system could fail.
Thanks so much, Tom. Ladies and gentlemen, we are getting down towards the end of our webinar this morning. We do greatly appreciate you all for joining us for our Business and Breakfast Part 1 of the Economy and Me series. We hope that you all will join us next Thursday at the same time. Tom will be back to discuss this further. Momentarily, you will see a poll pop up. We are asking for your feedback. So if you'll take 1 to 2 minutes at the end of this webinar to fill out those questions, we would greatly appreciate your feedback. Also, a copy of this recording is going to be available on the Emory Executive Education LinkedIn page. So please take the time to look for that if you're interested in getting a copy of this recording. Tom, I'm going to turn it back over to you.
Yeah, so Keisha, I did want to mention some things. One of them is that we're going to start a program that's going to start in 2 Fridays from now. It's a personal finance workshop. And this is to get people sort of thinking about what their personal finances look like. And I'm going to walk you through some tools and techniques in order to understand your budgeting, what your revenue looks like, trying to decipher what's happening in the stock market, understanding what's going on in the bond market. I mean, it's really sort of let's say a personal finance 101. And so you might be listening and saying, I don't need any help with my personal finances. But there might be a tool, a technique, something that somebody might offer that will give you some ideas about how to get your personal finances in better shape, or at least how to do some little forecasting, some budgeting, things of this nature. And it's going to be, let's say, every other Friday for like 5 or 6 weeks. And so the idea here is to just start thinking about this, being a little bit more proactive. We're also doing a workshop next week that looks more at the finance for non-financial managers. And this is more, let's say, on the business side. And so, Keisha, can you send out some stuff to our participants about these 2 different options? I think a lot of people might benefit from different kinds of discussions.
Absolutely, will do.
Okay, thank you. All right, thank you for your time, everybody, and I'll be back next Thursday.